Interest rates keep going up and up around the world, so banks keep putting up their mortgage rates as well, charging everyone a lot more. Is this another story of the greedy bankers just trying to make as much money as they can get away with again? Well, actually, for once, no, not really. But before I get into it, hello, this is the Watching Them YouTube channel and my name's Errol. I'm all about giving everyday tricks and tips to help you save and earn money. Okay, so you're probably thinking, how do you know this and what makes you say that? Well, I work as a mortgage advisor, so not only do I speak with mortgage companies on a day-to-day basis, I also see how much banks earn when they issue a mortgage to a customer, and I'm also able to see the changes to mortgage products and policies usually before they're released to the general public. So in this video, I'll share my insights into the recent changes I've seen in mortgage policies and products, and by the end of the video, you'll see how even though high street banks are charging more, why they're not making more. Now, because you're watching this video, I'm going to presume, dear viewer, that you already have a basic understanding of what mortgages are, the difference between repayment and interest-only mortgages, and the difference between fixed and variable rates. But to understand why the banks aren't making more money despite charging more, we've got to understand a bit more about how mortgage companies make their money. Mortgage companies either borrow from a central bank, in the UK that's the Bank of England, borrow from each other, which the LIBOR rate roughly shows, or via their own leveraged resources. They then lend that money to you at a higher rate. That's where they make their profit. So far, this is what most people understand. There's a lot more, of course, to the process, but that's basically it. Most high street banks use the Bank of England to fund their mortgages, and today, as I make this video, the Bank of England base rate is 3.5%. By the way, when I say high street banks, I'm usually referring to the biggest lenders in the market. In the UK, that would be Lloyds, Barclays, RBS, Santander, to name a few. They usually have physical banks on the high streets, hence the name. Now, if you were to get a 5-year fixed rate from a high street bank today, you'd be looking at around 5% at the moment. Now, out of the 5% rate the bank charges you, 3.5% would actually be used to pay the Bank of England, and 1.5% is what the bank makes from you as profit. The lowest cost high street lender in the UK would therefore usually charge around 1.5% above the base rate to provide you with a 5-year fixed mortgage. To put this into numbers, if you took a £200,000 repayment mortgage over 25 years on a 5-year fixed rate at 5%, that will cost you £1,169.18 a month. £833.33 would be interest and £335.85 would be capital. This is what actually pays down the mortgage. Now, this doesn't mean the bank makes £833.33 in profit, because out of that, your bank pays £583.33 to the Bank of England. That is the 3.5% they borrowed to be able to facilitate the mortgage to you. And your bank gets £250, that's the 1.5% they charged you on top, that's their profit. Therefore, out of the 5% they have charged at the £1,169.18 you'll pay per month, your bank is making just £250. Keep in mind, this is a basic example. The £250 profit the bank is making really only applies to the first month when the balance was $200,000. As it's a repayment mortgage, the amount decreases with each payment. So as the months and years go by, a larger portion of what you pay goes towards paying down the capital and less towards interest. Now, prior to 2022, over the last 10 years, the Bank of England base rate was around 0.5%. Sometimes it was a little bit less, sometimes it was a little bit more, but around 0.5% usually. And the best 5-year fixed rate was usually around 2 to 2.5%. Again, high street banks are charging around 1.5% for a 5-year fixed above the base rate. What would your £200,000 mortgage look like on a 2% rate? Well, very different. Monthly payments would have been around £847.71. Out of this, £333.33 is towards paying interest, and £514.38 is what goes towards capital. However, when you break it down further, This is when it gets really interesting. And here you'll see why the banks, particularly high street banks, aren't actually making more money from you despite charging you more. Because out of the £333.33 paid in interest, the mortgage company pays just £83.33 to the Bank of England. So that means they're still making £250 a month in profit. So that's right, that means the bank is still making the same money. So on your £200,000 mortgage, regardless if they're charging you a 2% rate with a monthly payment of £847.71, or a 5% rate with a monthly payment of £1,169.18, because the Bank of England base rate has changed from 0.5% pre-2022 to 3.5% now, the amount that the bank makes would still be around the same, £250. By the way, if you find this video interesting, I would really appreciate it if you could click the like button. Thanks a lot. So to answer the question, do high street banks make more money? The short answer is no. Even with higher interest rates at the moment, they're just not making more money. In the UK, high street banks mostly rely on the Bank of England for funding of their consumer mortgages, and they don't usually charge much more on top. As I say, usually around 1.5% for a 5-year fixed rate above the base rate. The higher the Bank of England base rate is, by the time you're watching this video, the base rate might be a bit higher. The higher the Bank of England base rate is, for banks who rely on them, directly or indirectly, the more they'll have to pay. So the more they'll need to pass on to the customer, and therefore overall they're not making any more money despite charging you, the customer, more. In fact, there could be an argument that between all their customers, they would be earning less, because the more expensive mortgages become, the less people can actually afford to take them out. Meaning overall, the less customers the banks will be able to give mortgages to and make money from. Okay, you'll notice that it's a new day, and I was editing this video thinking, do you know what, I haven't really told the complete story. There aren't just high street banks out there are plenty of specialist lenders who charge a much higher interest rate for much higher profit margins on each individual customer. Now, these particular lenders are able to definitely take advantage of the situation of higher Bank of England base rates, because with that higher profit margin and higher interest rate that they naturally charge, perhaps 3 or even 4% above the Bank of England base rate, they can get away with charging even more because it's effectively hiding their already high interest rates. And not only that, not all lenders have access to the Bank of England's lending facilities. Some rely on the LIBOR rates, which is basically the rates they borrow from each other lenders. Some lenders rely more on their own resources, more than borrowed money. So this way they don't have to pay back a third party such as the Bank of England, and this allows them to make even more profit. Now, just like how customers refinance to get better rates, mortgage companies can also refinance any borrowed money they've received to issue you your mortgage, and to get a better rate as well for themselves. If they reduce their rates they received from a third party, they'll be able to make more money, more profit from the mortgage that they have provided you. They could even simply sell your mortgage to another lender, etc., etc. So, as I say, I haven't gone into all those or the other additional factors in this video, but if you would like me to do so, or if you find anything in this video interesting, please leave a like and subscribe so I can keep you up to date on the latest releases. Bye for now.